Stubborn US inflation settles above the desired 2% target, putting the Fed on notice. Welcome to Macromatters, your regular look at what's driving the global economy. I'm Peter Devlin. Inflation optimists were riding high at the start of the year. Price pressures seem to be cooling quickly, and market pricing suggests that the Federal Reserve might lower rates by 1.75 percentage points this year. Fast forward, and 1 percentage point is looking much more likely. So, with traders on high alert for potential Donald Trump policies that could inflame the problem, how cautious will the US Central Bank be in 2025? Well, to answer that and more, I'm joined by Wang, US economist at HSBC. Welcome, Ryan. Thanks very much for joining us. So let's start with the data this week. What's keeping inflation above the Fed's comfort zone?
Yeah, thanks so much for having me. Well, based on the most recent inflation numbers, I would say it's still mostly services inflation that's keeping the Fed's preferred measure, PCE inflation, a bit closer to the 3% level than the 2% target that the Fed has. Goods inflation has slowed significantly. Now, of course, we all know that doesn't mean that goods prices have returned to where they were, but that's not really the issue anymore in terms of the inflation rate. In a broader perspective, it's really rental inflation and non-housing services inflation that's keeping the rate a little bit high.
So let's look at the US economy as a whole. Unemployment still low by historical standards, manufacturing getting no worse, and services still thriving. Is a cut next week really warranted from the Fed?
Well, that's a very interesting question. I think some of the most recent economic data releases have, in fact, been a little bit confusing, a little bit contradictory. For example, you take the latest jobs report, and it showed more or less an expected rebound in employment growth according to a survey of businesses. But then when you flip to an alternative survey of households, actually there's been quite a bit of weakness in the last 2 months, and the unemployment rate has risen back to nearly 4.3%, which is where we were a few months ago. So I think overall the economy is in good shape, but you have a few different pieces of data that are sending some slightly confusing signals. Overall, though, I do think that the Fed will deliver a rate cut. It's partly on the back that yes, inflation has stalled somewhat in terms of its downward progress in recent months, but it's still much slower than it was a couple of years ago. The Fed, of course, has only just begun its rate cutting campaign, having delivered 75 basis points so far. And I do think another 25 basis points, at least at the December meeting, is likely to be delivered.
So let's look closer at that rate cutting campaign, like you said. Policymakers have repeatedly said that monetary policy is still in restrictive territory. Will we see that, a reduction in cut expectations for 2025 in the dot plot coming up on next week? Will that be down from September's projected 4?
There's some chance that actually that 100 basis points of projected easing in 2025, presumably after a 25 basis point rate cut in December, will just simply stay in place. But there's also, I believe, some chance that it'll be scaled back to show 75 basis points of rate cuts next year. So I think it'll be a close call between 75 versus 100 in terms of the projected pace of rate cuts next year. And it does reflect, again, broad resilience in the economy compared to what expectations might have been 3 months ago, inflation that's looking still a bit sticky, and as I said, mixed signals coming out of the labor market.
So meanwhile, in January, futures traders are confident that the Fed will pause. Could we see the Fed stop cold in their easing cycle and wait a few months for a clearer picture?
I think part of what is being built into market expectations for the January meeting is a bit related to what I mentioned, this kind of meeting versus meeting where projections are delivered versus the off meetings where really there is no guidance. And so, this is a little bit of a technical phenomenon, but I think it leads some traders to think that action is more likely at meetings where projections are delivered. In other words, the one that we get next week and not the subsequent meeting in January. And when you look a little bit further out through next year, you can see that this pricing, this sort of pattern is visible in the pricing. So what I think it means is if the Fed does choose to skip a meeting in January, no, I don't think it means necessarily the end of the cutting cycle. After all, as we just discussed, the Fed is clearly not anticipating reducing rates at every single of the 8 policy meetings in 2025. So that's not the interpretation I would take. I think it's more of this idea of being a bit more cautious, having delivered some rate cuts, and perhaps slowing that pace down into next year.
So finally, Ryan, comments from Treasury Secretary Janet Yellen. She warned this week that Trump could derail the inflation progress. So as the fight persists, could it force a change to Trump's plans for tax cuts and tariffs?
Now, I would say back in the earlier round of tariffs that we saw in 2018 and 2019, there actually was not that much impact on inflation at the consumer level. There were a few different reasons for that. Partly was due to the composition of the tariffs, also because the foreign exchange value of the US dollar appreciated as it has done recently, and that kind of offsets some of the inflationary implications for the US. And then when you turn to tax policy, well, one thing to note here is that really tax policy is being considered in terms of what changes may come in 2026. So it's not really something that should affect the economy too much in 2025, although that's when the bulk of the negotiations about the exact parameters will be unfolding. So it's going to be very much in focus, but it's important to note that that tax changes aren't really expected until well over a year from now.
Ryan Wang from HSBC. Many thanks for your thoughts. And that's Macromatters. Don't forget, you can watch more videos on Reuters.com.